Welcome to the Founders Odyssey podcast, where we educate, inspire, and create a supportive community for our fellow founders. Today, we are joined by Jason Crystal, the funding magician, with his extensive background in creating successful funding campaigns yielding millions for startup businesses. With his unique and detailed experience of crowdfunding and providing companies the information, strategy, and clarity, Jason is an extremely important person for any company. Having built a successful software company from the idea to acquisition, he knows firsthand the need for capital and knowledge it takes to go through the preparation to sell. He and his next venture will help you with the funds and raising for your company through Silicon Prairie, where they are on a mission to help founders collectively raise $15 million throughout crowdfunding in 2022. Join us today for this exclusive interview with Jason. Nice to have you aboard.
Thanks for having me. Just one quick note, as funding portals, we're intermediaries. So we're intermediaries between the issuer and the investors. So we provide the technology and the platform, but we don't solicit funds on their behalf. And so I just want to make sure that kind of is clear.
No, that's perfect, man. We're excited to hop into this and really share a little bit of your expertise and also your background and really just the overall excitement that we have for startups in general. So let's share a little bit about how you got started in business and really what took you down the road of understanding, software development and building companies, things like that.
Yeah, no, great question. Thank you for having me. I started after college. I studied economics and was a proprietary trader, traded commodities like oil, gold, silver, did that for a number of years. I moved from Reno, Nevada to Israel. I was in Israel about 5 years. I was in the IDF there and got a master's in Homeland Security and Counterterrorism. And I thought that I wanted to be a securities analyst, the other type of security. From there, I found that once you have dual citizenship, it's kind of tough to get a security clearance in either country. And got my first tech job working for a global payments company called Payoneer. I was a fraud analyst there, and that was my first exposure to working with a technology company. I had an opportunity that came up through a friend of mine in New York at a company called Broker Genius, and was a pricing analyst there, and became director of operations and eventually COO, and got a chance to see a company kind of grow very rapidly and scale successfully. And I got a chance to, hire a lot of people, start a bunch of different departments. That's really where I got a lot of experience in technology.
That's awesome. I know it seems like, wow, going from the United States to Israel, let's just touch on a little bit of the cultural change, right? Because this will play into how, as an entrepreneur, we need to be moldable and we need to be able to shift, right? So let's talk about what the culture was like there.
Yeah, it's a great place to live. I didn't know the language at the time that I moved there. I'm not so good at languages. So it took me a while to pick that up and really pushed me way outside of my comfort zone. Doing a lot of things and learning a lot of things that were new. And I think that did give me a lot to really feel comfortable being uncomfortable, if that makes sense.
It makes 100% sense. I know, and right before we hopped on this podcast today, we were talking about the magic of thinking big and getting outside of your comfort zone and doing things that really will challenge you. And it sounds like, you doing that really challenged you. And I think, there are challenges, as we know, that arise in the founder as he's trying to build his company and to solve problems within, the business space, right? So let's jump into understanding some of the problems that you have seen with founders that are trying to raise funds, because that is one of the reasons why we've had you on the podcast today to talk about crowdfunding. Could you talk to the founders out there?
Yeah, so I have a good bit of experience fundraising for at companies that I was at previously. Helped raise a Series A that was about 20 million Series A, and that was a more traditional kind of VC round that I was involved helping with diligence and got to see the process of what that looks like up close. And then for my own company, I raised a friends and family pre-seed and a seed. And that was from the seed was from traditional angel syndicates, a couple of them. And working in crowdfunding, I've seen a lot of campaigns and kind of what makes them successful and what campaigns tend to fail. So I have a pretty good cross section of experience in different types of funding. And I guess to answer your question at a high level for founders is, the best money you raise is the money that you never have to raise. So if you can be customer funded or self-funded, one of the biggest challenges I see a lot of the time is companies fail because they start scaling prematurely. And when you raise money, you have a lot of pressure to start growing and hiring before you establish a real strong product market fit. And so that would be my advice to founders is, I think it's Damon John has a book called The Power of Broke, where it really forces you to make good decisions when you don't have a lot of money. It's kind of a superpower. And most people don't think about it that way. They think, money's a magic wand that's going to solve your problems. But most companies fail because they don't have product market fit, not because they run out of cash. Companies obviously do fail because they run out of cash as well. It's just not the number one reason that they fail.
That's so good. So let's dig a little bit deeper into that founder that's struggling to raise funds and what, as a doctor, because I found that you're almost like a doctor of helping people raise funds, right? So let's look at the right cocktail of what percentages we do on crowdsource equity as opposed to VC funding, or is there a kind of a sweet spot on how you would suggest someone to raise funds?
Yeah, so it's finding funding is always about finding the right partners for the size and stage that you're at. So if you mentioned VC, so a lot of people think that VC funding, they're like, I want to have one company on my cap table, I need VC money. Well, most VCs, they have a very similar investment thesis. They're looking for companies that have traction and revenue, have a product in the market, are growing at a certain rate, and that they're trying to build kind of a unicorn or a decacorn. They have a go public or die strategy. That might not be the strategy that you as a founder, you might not want to build that type of company. So if you're trying to build a lifestyle business that's going to support you and a small team, or you don't have ambitions to build $1 billion company, going and getting VC funding, even if they'll give it to you, might not be the right choice. So it really depends on the size and stage that you're at. And then it depends on, if you want to do equity or debt for raising money. It depends on a lot of things, but it always, before you can raise money, your company first has to be investable. And you have to have kind of the fundamentals of what makes a company investable. You have to be solving a real problem. You have to, be better than the competition and or doing it in a novel way, all sorts of things. So I did that answer your question?
Absolutely. I'm just trying to think about those founders out there that are thinking, well, where should I raise funds? Number one, who should I raise from? Number two, what does my company need to look like when, I'm going to pitch, of course, and then do I even need to raise funds, right? So a lot of these questions, it's not always do I try to get funds as soon as possible within the company, right? Because there's a stage of bootstrapping, there's a stage of utilizing the power of broke, like you said, and I believe that to be very powerful, a powerful mindset that you must have as a founder. So let's transition into understanding more about debt and equity, because I know that those were two specific topics that you covered just briefly, but can we go into a little bit more detail on each of those?
Yeah, sure. So there are different stages. There's what's called generally a pre-seed, and every company defines these stages a little bit differently. But a pre-seed is typically when you're pre-product, pre-revenue, and this is where most companies, really struggle because they have expenses, but they don't yet have revenue. Then some companies are able to skip the pre-seed stage and either self-fund or bootstrap, and then raise a seed to go to market. And then typically a Series A is when you have product market fit, and you can answer the question, if you give me this money, we're pretty confident that if we put it into these marketing channels that we already kind of have a formula established, that it's going to spit out this much return. If you can't answer that question, you're probably not ready to raise a Series A if you don't have that type of visibility. So going back to your previous question about, there's the things that you're talking about, equity, debt, those are called securities. Yep. So, and by the way, none of this is investment advice. Always consult your own, kind of financial advisor. And your own legal team and trusted professionals. But these are called securities, right? So there's different types. There's equity. Equity is when you sell shares in your company in exchange for an investment. And it typically comes in two forms, either preferred stock or common stock. And there's all sorts of terms like voting rights and all sorts of things go into it besides that. But essentially you're selling shares in your company. You're giving up some control of your company in exchange for money. And usually that's at a predetermined valuation, either pre-money or post-money. And so equity tends to be a good fit for companies that are very high risk, because most startups fail. 90% of startups fail, in the first couple of years. So if you're an investor and you're investing in startups, you need your winners to pay for your losers. So the advice that I always would give to founders is, when you're trying to raise money, think about it from the investor perspective and what they're trying to achieve. So as founders, we get really good at pitching our products, but we aren't very good about pitching our companies without practice. So you're pitching the upside of your company. A lot of times when I hear founders pitching, they're doing product pitches like they would to a customer. But an investor is looking for upside in their investment, and they want to know what's the business plan of the company, not if they're not necessarily a fit for the product. So equity tends to be a good fit for companies that are high risk, typically startups that have ambitions to grow, because they don't have cash flow yet, or they don't have enough cash flow to service debt. So equity is kind of their only option. And even if they wanted debt, typically they can't get it because the risk is too high. The return that somebody would want is too great for them to be able to repay it. So then going into debt. So debt comes in many forms as well. There's what are called term notes, which most people are familiar with, where I borrow $100 at 10% interest, and I pay back the interest until I repay the loan. There's also what are called rev share notes, which can be a good option for small businesses, where you are paying a percentage of the revenue until you pay back a multiple. So equity and debt are two common types of securities, but there's also what are called hybrids. Hybrids are things like convertible notes, which are have some features of equity and some features of debt. And then there's also what are called derivatives. And derivatives can be, you might have heard of a safe note or a KISS. A safe was developed by Y Combinator to solve the problem for early stage startups of it's very hard to value your company when you're at an early stage and you haven't gone to market. So what a safe is you can establish a ceiling and a discount, and you convert the safe into equity in the next price round, generally at a discount. So just to keep numbers kind of even, let's say you say that there's a ceiling on the safe of $10 million at a 10% discount. If a year later you raise money at 10 million, the safe would convert at 9 million. So safes are becoming very, very popular for early stage startups, because an investor might agree on the concept and the founder might need the money, but it's very hard to agree on a valuation at that very early stage because you don't have enough data. So safes are a very popular derivative that generally become equity in the future. Those are the main types of securities.
Let's talk about debt. And I know we've went over equity and kind of you very well shaped that out for us. But what about debt?
Yeah. So debt, so like equity tends to be a good fit for startups, debt tends to be a good fit for either small businesses or scale ups where I'll give you an example, maybe a restaurant, maybe a car wash, maybe real estate tends to be a very good fit for debt because there's an underlying asset. So if you think about it as, let's say you're a franchise owner of a restaurant, for example, if you sell equity in the company, and then you might need, more money in the future. So you sell some more equity, then you sell some more equity. Pretty soon you only have a small chunk of your company left. And small businesses scale linearly. So if you want to open up another restaurant, you have to hire more people. Your profits and your revenue growth scale linearly. You can grow, but your growth is kind of capped. So if you keep selling chunks of your company and your growth is linear, eventually you're going to be working for the shareholders and you're not going to have enough skin in the game to incent you to continue working. So that's why, where you see a lot of small business owners that are very hesitant about ever selling equity in their company because they don't want to end up upside down in their company. So for those types of businesses, debt tends to be a really good fit because once you pay it off, that liability on your books goes away.
That's a great job of explaining both the two. I know that founders out there, some people are looking at a mixture of the two, and then it really all depends on what stage. And I hope everyone is hearing that out there today. Let's cover over your scenario where you were raising money to the tune of about 20 million for the last company that you were helping build. So
a few companies ago for the company that I founded, we ended up raising about a little less than $500,000 in 2 rounds.
Sure.
And we did that as equity.
Well, let's go through the one that you were raising about 20 million for, and then kind of just take us through that process, and what you had to go through. What was the preparation for that? Because there are founders out there right now that are in a Series A, and they're looking to, maybe derive some knowledge from you and understand that.
Yeah. So at that time, I was more on the operations side. So I wasn't responsible for finding the specific, venture partners, but I was helping facilitate the diligence requests and kind of got to see what that process looks like. So for venture capital firms, they're looking for companies that have the ability to become, very valuable, to dominate an industry, or they're creating something new. So they operate on what's called the power rule. So very few of their portfolio companies are going to be real big winners, and that's going to pay for all their losers. So there's all different types of VCs, and they invest at all different types of stages. So sometimes there are pre-seed and seed VCs there, but most of them are kind of either pre-Series A or Series A and beyond. We are seeing a trend in kind of capital formation, that PE companies that used to be very late stage are getting more involved at the VC space. And then venture capital groups are also getting involved, typically where you would see a lot of angel investor groups earlier. So you are seeing things kind of condensed down. But essentially, the things that you want to look for are, what industries do they invest in? So if they could be, you could really like them as partners, but if they only invest in biotech and you're a manufacturing company, they're never going to invest in your company. So the things that you want to know are, what stage do they invest at? So are they pre-seed, are they seed, are they Series A, and are you at that stage? And then what industries do they invest in? If you go to these websites, most of the time what you can see is you'll see a list of their portfolio companies, and you want to look for companies that look like you. So if a company isn't like you, in their portfolio, they might invest in companies like you. And they don't want their time wasted, and you don't want to waste your time as a founder. So before going through the process of sending a really custom email and sending your pitch and having a first meeting with an analyst, and then you get to a partner, it's a sales process. So before going through that process, always take time to ask the question, what stage do you invest in? What industries do you invest in? What are your requirements? A lot of them have requirements called covenants. So if they might have revenue thresholds, you have to have a certain amount of monthly recurring revenue. You might have to have your clients not concentrated in one or two clients make up 80% of your revenue. They might require that your revenue streams be more fragmented. So figure out what the requirements are, what stage they invest in, what industries they invest in, and make sure that as you go on the hunt, you're working with lists of people who meet your requirements, so you don't waste your time.
So important. I know that it can almost seem like a circus for many founders. You're going through the process, and if you don't know this starting out, then you're going to waste a lot of time. So Jason, thank you for sharing that information for those founders out there that are on the rat race right now.
And that's true of all stages, right? That's true of all stages. You want to make sure, hey, this is what we do real briefly. What types of industries do you invest in? What stage? Does this fit your thesis? And they'll tell you. It's not a secret. Usually, it's on their website. So usually, they don't want their time wasted. They put their thesis on their website and their portfolio companies on their website.
Yes. Yeah, that's good. Well, let's talk about the democratization of crowdsource funding. And that is something that I can automatically see you're smiling inside and you're wanting to touch on because it's so effective. And, you want a lot of people that can buy in as even a marketing tool for your business. So, whether they do a 500 or 1,000 or 2,000 or whatever, it's a small amount into your business. It could really jumpstart your company. But how do you do that from, kind of a legal standpoint of, once again, this isn't legal advice, but how do you put it together in order for someone to invest in a company? And I know your system and the company you're working with helps with that as well.
Yeah. So that's a great question. So investment crowdfunding, so let's kind of back up. When we talk about crowdfunding, there's two types. There's what's called non-investment and investment. So a lot of people are familiar with non-investment, which is like Kickstarter, Indiegogo, which is called rewards crowdfunding. And they're familiar with GoFundMe, which is donation crowdfunding. So those are unregulated. They're typically not overseen by FINRA or the SEC. And you're not getting a security like debt or equity or derivative or hybrid. You're getting a shirt or a hat, or you're just giving someone money. So that's why they're not overseen by those regulatory bodies. On the other side, there's what's called investment crowdfunding. And investment crowdfunding came about, I believe it came about in 2012, but there were some amendments that took place around 2016 that really made investment crowdfunding more viable for founders and for investors. And that's when we really started to see it start to grow through the Jobs Act, the Jumpstart Our Businesses Act. And so about $1 billion cumulatively has been raised using an exemption called Reg CF since the Jobs Act went into place. And 500 million of that came last year in 2021. So it's really starting to accelerate, and they're anticipating, so far, I think I just read in a recent report that in January was 20% higher year over year than last year for Reg CF. So it is starting to grow, and it is a really good option for founders. And we can dive more into that if you'd like.
Yeah, absolutely. So let's take a look at a cap table, and how do you allocate, your cap table correctly to be able to have funds that come in? What does that look like?
This is a great question. So, and we get this a lot. So let's talk about how crowdfunding works. Investment crowdfunding. Let's focus there. So you have to list your offering, which is sometimes called a campaign, on a portal. And there's two types of portals. There's what are called funding portals, and funding portals, are overseen by FINRA and the SEC. And that's what my venture was, where the funding portal is an intermediary between the business and the investors. So there's a couple supervisory duties that the funding portal has to, check. They do background checks on the beneficial owners. You have to have a legal entity in the United States to use this exemption. And then they make sure that the regulatory form, which is called the Form C, is materially complete. And that consists of a business plan, financial history, financial forecast, risks. So that's a legal document of disclosures, kind of similar to a PPM, a private placement memorandum. If anyone's ever done a Reg D for accredited investors only, it's like that, but it's called the Form C. And on a funding portal using exemption Reg CF, people can raise up to $5 million from both unaccredited and accredited investors. And at Silicon Prairie, our founder, Dave Duccini, likes to call them not yet accredited investors. So anyone can kind of invest in this offering. Now, to circle back to your question, what are they giving? So they determine the security that they're offering. So the way that it works is someone gets to a campaign page. They see, okay, here's what this company is all about. Here's the regulatory form. This company is offering me a security, and they can look and read about the security. So that security is either debt or equity or a hybrid or a derivative. It depends on what they choose. Now, there's typically a minimum goal and a maximum goal. So if the minimum goal is exceeded, then the campaign is successful. If the minimum goal is not exceeded during the duration of the campaign, anyone who invested gets a full refund, is how it works on most platforms, and the campaign is unsuccessful. So now, if you're somewhere between the minimum goal and the maximum goal, then it's just prorated depending on what you raised. So for example, just to keep numbers easy, let's say you said, my company, is worth, $10 million, right? I'm doing an equity investment crowdfunding campaign, and I value my company at a $10 million valuation. And I'm trying to raise $100,000. So if you're trying to raise $100,000, then that would be, you're selling 10% of your company, right? But let's say you only raised $50,000 and your minimum goal was 10,000. Well, then it just, based on how much you raised, then you would just give shares equal to 5% of your company instead of 10%. And you would just, the remaining shares would go back into what the pool. This is a really common question that we get about how to structure this, and because people worry about over allocating or under allocating. And one of the things we do at Silicon Prairie is we do require all the issuers, so the business owners, to work with a securities attorney on our platform that represents them. And this way, when they have questions about, valuation, what security type, I obviously have opinions on this stuff, but we really want to make sure people have their own representation and they have their own securities attorney who represents them, who they can ask questions.
No, that's good. I want to back up here. You said something about, if I was a founder personally, I've got a company and, it's a $10 million valuation. I want to raise, like you said, 100,000. I've got now that carved out in my cap table. And then I ended up raising like 80,000 throughout that. I can't use any of that money because we have to give a refund back to all of those who.
No. Yeah, I'm glad you're asking. So once you pass the minimum goal that you set, so let's say in this case it's 10,000, the campaign is successful. So anywhere between the minimum and the max goal by the campaign end is campaign success. So in the scenario that you just talked about, where you raised, I believe you said 80,000 of the 100,000, yes, and you were selling 10%. So the campaign would be successful. People would sign their subscription agreements. A subscription agreement is between you and the investor, not the portal. So after a campaign is successful, the business and the investor have a signed agreement. Most portals, that takes place on the portal, including ours. And then, you know, you've got all those agreements, and it's a legal document, and the campaign is successful. And you know, you will have sold in that scenario 8% of the company to those shareholders, and it would be successful. So you have to exceed the minimum goal. And one of the reasons that in the Form C, when we talk about use of funds, so one of the things investors always want to know about is, okay, you need money. What do you need it for? So a lot of times in a Form C, we see people say, if I raise the minimum, this is how I would spend it. And if I raise the maximum, this is how I would spend it, because you don't know what you're going to raise. So we always tell people, you know, the minimum should be whatever is going to get you to the next growth milestone, to whatever the next level is, right? So let's just use a restaurant, for example. If I'm a restaurant owner and I say, I need, you know, a minimum goal of 50,000 and a maximum goal of 250,000. And I'll say, okay, if I raise the minimum goal, I'm going to get this new oven that I've been needing because my oven is broken. But if I raise the minimum goal, I'm going to get the oven. But if I raise the maximum goal, I'm going to get the oven. I'm going to be able to put a down payment on a new location and hire an employee. And then that way people kind of understand, you know, how does the founder intend to use the funds if they raise their minimum goal and the maximum goal? And this is something that's really important because sometimes we see really, really wide spreads. You know, that could be problematic from an investor perspective. If they don't think that your minimum goal is actually enough to help you get to the next level, or to, you know, achieve something like break even or some type of milestone that would enable you to raise the next round, a lot of times that's a red flag for investors.
Just because they would think that you didn't do your homework properly and looked at your financial forecasts?
Yeah, I mean, that's part of it. Or just that you know, not being realistic about what they actually need to kind of be successful.
Yeah, I've seen that and heard that from many people, not just yourself, you know, here and mentors and advisors who have said that it's important that we are always looking at, you know, exceeding.
It always takes longer and costs more than you think. That's probably the best advice I've ever gotten is it's always going to take longer and cost more than whatever you think.
I love it. Yeah, that's so true. Let's talk a little bit about Silicon Prairie. I know you've alluded to what you guys do and how you can help, and it seems like it can be a complex situation, but it seems that you guys have the mission to make it simple and to really scale and to align yourselves with founders that really need capital. So
yeah,
talk to us about
that. So we were licensed, my venture, as a funding portal, and we were the first mobile only crowdfunding portal that I think may have ever existed. We did add a web app later on, but we joined the team at Silicon Prairie. They have a lot of really exciting technology and regulatory licenses. So in addition to being a funding portal, they're also a broker dealer. So they can do Reg CFs, they can do Reg Ds. They're also what's called a transfer agent. So they can do things like help people, you know, with hosting the cap table and things like that. And we're in the process of getting an ATS license and going through that process. So the team is fantastic there. So we're really excited to have joined that team, my partner and I. And so we're in the process now of adapting the mobile technology to their platform. And we are onboarding more issuers who want to launch, you know, Reg CF and Reg D campaigns. You know, we're a crowdfunding platform. We are very different from other kind of big brand, you know, I don't want to name any, but big brand portals. One of the things that makes us different is we really believe that for founders, there's very few activities where you can drive investments and build your brand and get the word out and create brand champions at the same time. And crowdfunding is really one of those activities. And so what's different about our platform is we really encourage people to put an invest button on their website that redirects to their campaign and is kind of a walled garden. And that way they can drive traffic to their website and they can get the word out about their company while also kind of raising funding. And we never take the investments that come through the portal. We never take the investor community that signs up for a specific campaign, and we don't send them other offerings. So, that's the business model of most big brand platforms is they'll kind of harvest the investor network or contacts of the issuers and kind of monetize that by sending them other offerings. We know from looking at the data that the vast majority of investments come from the community of the issuer, which is something else that I want to touch on about crowdfunding. But because we know that, we really try and be respectful of the brand and respect the privacy of the network and relationships of the issuer. And that's a big thing that differentiates us from other portals.
I think that's huge. That was the first thing that you told me a little while ago when we talked, and I had experienced on other platforms multiple options, right? It's like going to the grocery store. I've got so many different options. I don't even know what to choose, right? I just want to get my food and get out. And well, it's almost the same here with investors. Like, I don't want to be bombarded with other opportunities. I want to focus in on this one specific topic that I know and like and trust whoever has invited me here through.
Yeah. So you said a couple things that we know are really important. The first wave of investors are always people who know, like, and trust the founder. And so when people are thinking about, is investment crowdfunding right for me? The first thing I always tell them is, do you have an audience of people that would be interested in investing in your campaign? So at Silicon Prairie, the saying is we try and identify who does well when you do well, right? So that's your audience. We encourage people to start with what's called the Test the Waters campaign, where they can start list building, they could get surveys filled out, they can do kind of discovery, and then they can launch their campaign when they're ready, when they feel like they're ready. So I think that's really important that you mentioned that.
Well, Jason, I love what you're doing, and you've really got the end user in mind on how you've built this platform. It sounds like, as far as from the founder's perspective and the investor's perspective on both sides. Founder needs an expedited way and organized way to leverage a platform to build a following and also build their little nest egg so they can reinvest into their business, and being transparent with all of their investors who are focused in and they really want to see them succeed. So I think you guys have done a wonderful job. Is there anything else you want to say to the founders out there that you're thinking about?
Yeah. So just no matter what path you choose, if you choose investment crowdfunding, if you choose angels, or more traditional forms of fundraising, the thing that I always try and hammer home in my first conversation with founders is there's no easy way to raise money. Raising money is difficult. If you're doing investment crowdfunding, the difficulties are different. I'm sorry. So, you might have to spend time making a really good pitch video, having good product pictures, telling your story, identifying audiences, creating marketing emails to reach out to those audiences. There's a lot of work that goes into that up front. If you're raising from traditional sources, you're going to have to build lists, but instead of lists of, you'll have to build lists of, do these investors invest in my size and stage? How do I get in front of them? You're going to have to talk to a lot of them one-on-one as opposed to one-to-many, like in crowdfunding. But there's no right or wrong answer. And people always ask me kind of, which is better. And the answer is the best option is, do you have a business that doesn't need to raise money? But then if you have to raise money, it's just about doing what's right for your business. So if investment crowdfunding, really, you have control over your security that you're offering, and the terms, which you typically don't when you're going traditional paths. You're creating brand champions, but there are expenses to creating that Form C and to getting the word out about your campaign, both in terms of time and resources. And on the other side, there's also time and effort. So you have to just continue building your business while you solve your capital constraint. And if you stop building your business to focus on raising money because you think money will magically fix all the problems, then you're not showing traction and it becomes harder to raise money and it kind of becomes a spiral. So, I think that this is one of the reasons that companies with co-founders tend to raise more money and tend to have higher valuations is you really have to be able to divide and conquer. If you're a solo founder, raising money is a full-time job almost. So, it is difficult, but, I'm obviously a huge believer in investment crowdfunding. I think it has a lot of capabilities to level the playing field. And it is an activity where you can build your business, get customer feedback, and raise money at the same time. So I think it's a great option for most founders. But I would never tell somebody it's the only option or don't do traditional. It's a personal choice of, how you want to build your capital stack and how you want to build your business.
Well, thank you, Jason, for spending some time today with us and helping all of you founders out there, and even myself included, because I'm always curious to hear from the different guests we have on the Founders Odyssey podcast. So once again, we help to educate, create supportive communities, and help to inspire you as founders to build an amazing company and really just conquer the world. So thank you once again, and we'll look forward to touching base with you on the next podcast.
Thanks for having me.